Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah, you're watching IndianOpen. Let's go straight to the headlines at this hour. Theresa May convinces her cabinet on the Brexit deal, will now take it to the European Union for the final stamp of approval. Vodafone Idea will raise 25,000 crore rupees to pay debt, leading to an equity dilution of more than 40%. Yes Bank's non-executive chairman Ashok Chawla steps down with immediate effect, citing his inability to give more time to the bank to oversee the transition from Rana Kapoor. And ING is looking to sell its remaining stake in Kotak Mahindra Bank. The sale might happen as early as this week, say sources to Bloomberg Quint. Well, let's take a look at the brief trade setup for the day. The world markets not too newsy, which is probably not a bad thing as well. The US markets, well, you can argue that they ended lower for the sixth straight day, and there were about 1% cuts that came in into a couple of these major indices as well. So the S&P was down about 0.75%, but the sixth straight day of fall for the S&P 500. And if you frankly just look at what Dow, S&P and Nasdaq have done for the last 2 or 3 sessions, there has been pain. Nasdaq was down about 1% yesterday as well. Apple is on the list of losers yet again. That has, well, it's not had repercussions, but it has had some impact on the sentiment overall because the flows have been very strong. Asian markets are starting off the day again in a mixed fashion. I think the crude cool off, and even though crude may have gone up marginally from 65 to 66, but the fact that it stayed lower is helping the world markets. SGX Nifty 2 about 1/3% in the green. So it's not a bad morning for the Asian markets. The question mark only is whether it will remain a lackluster morning or can move up. Now, frankly, our markets, it was a high volume day yesterday. After a long time, we saw volumes pick up meaningfully in trade, but it saw very little institutional activity. The FIDI volumes, buy-sell numbers were 250 crores. So there was hardly any major participation that came in from the large institutional investors. But there was one takeaway to my mind that happened in trade yesterday, and that was the concerted buying that we saw in large private sector banks. Say for Kotak, almost everything else did very well. PSU banks did well and large private banks did very well. Just sample this. Look at the kind of delivery percentages that came into some of the stocks. ICICI Bank traded at record highs yesterday, 50% delivery buying. HDFC Bank, after a long time, was in the list of the top contributors. That the delivery percentage buying was about close to 80%. Kotak Bank sold off in trade, and maybe on account of this news that we learned in the evening, that at least sources said to us in the evening, but maybe some people knew, it saw fairly significant delivery-based selling as well, to the tune of about 50-odd%. And there is a bit of a chalk and cheese behavior out here in the banking space. Just look at what's happened the last 2 or 3 months for some of these large private sector banks, be it ICICI, be it HDFC or Kotak, and you will see a stark difference in the performance. The yellow worm, naturally so is ICICI Bank, and that's leading the charge. Remember last Monday, we were talking about the things that could work for ICICI Bank. People are surely buying into that. So ICICI Bank is that one which is really leading the charge. Kotak and HDFC Bank have been a big lackluster, but yesterday was the first session of serious buying that we saw, delivery-based buyings, to my mind at least, that we saw in the large private sector banks. Let's see if that lasts. For all cryptocurrency fans, just one piece of bad news, non-markets, but Bitcoin has broken down to sub $6,000, and this is the lowest level in the last 1 year. Not that too many people pay any heed to Bitcoin anymore compared to the frenzy that it had created this time last year, but just an interesting chart out here. However, for stocks to watch in the session today, and I think there are a bunch of names that we should monitor. Kotak Bank, as we said, the source is telling Bloomberg Quint that ING is likely to sell the remaining stake in the bank this week. This is strictly source-based information. People privy with the matter telling Bloomberg Quint. But do watch out for Kotak Bank and see if there's some more pressure on that stock today. United Breweries, I thought the numbers look very interesting. I think the distillery companies have been chalk and cheese. The large ones have done well, the small ones haven't. So Radico, United Spirits, United Breweries, now good numbers. I think UV numbers particularly very strong. EBITDA margins expanded quite meaningfully. Net profit therefore jumped about 74.5%. I'm really looking forward to Agam's discussion with Shekhar Ramamurthy today at 10. I think it'll be a very important conversation to monitor today. Then some poor numbers that came in, or at least the margins came off for 2 or 3 of these companies, large names in that sense. Grasim, Vodafone Idea, Thermax, all of these saw margins come off quite meaningfully in the reported quarter. Let's see if there are some result reactions to thereof. Vodafone Idea, of course, has other news bits as well. The equity dilution part that I spoke about. The board is evaluating raising 25,000 crores worth via equity, and this is serious equity dilution. It's maybe a fight for survival, but serious equity dilution. I don't think this should sit down too well with minority investors, but the stock is corrected quite a bit too, so difficult to gauge what could happen today. I would be surprised if it reacts too positively, by the way. The numbers were bad and the large equity dilution should start off weak. Good numbers for two names, I thought, Power Mech as well as Indian Hotels. The losses narrowed, their EBITDA performance looked very strong for Indian Hotels. Let's wait and watch if that one reacts positively. Last but not the least, Monsanto. I don't know, just the back of envelope calculations that I did seem to suggest that there is a small arbitrage available, but essentially the news is that shareholders of Monsanto will receive 2 shares of Bayer Crop for every 3 held. So maybe minor reactions in the price of Monsanto in the session today. Let's wait and watch. Anyways, let's tell you what's lined up on First Word today. The second quarter has been the toughest in more than 3 years for the Indian Airlines. Sumit Sarkar joins in to tell us why. Then we dwell upon Vodafone Idea's fundraising plans, which was more or less a given since their mergers agreement said so. But what is the impact for a minority shareholder? I try and dwell upon it a bit. Yash then comes in and joins us and tells us what FIs have bought and sold in the second quarter. And then Indian Hotels, as we said, very strong quarter, will now focus on margins, says its new MD and CEO, Puneet Chhatwal. We have a small conversation with that management. However, let's start off with aviation. Rock solid the last 2 days. While it's been a worst quarter in at least 3 years for the listed airlines in India, the combined loss posted by the 3 players crossed 2,500 crore rupees as their fuel bill kept on rising in the second quarter. Some of the pain was also inflicted by the airlines themselves, with all of them choosing to offer discounts to customers. So really tough quarter, Sumit, for these companies. Is there any kind of silver lining?
Well, there are some of the silver linings, but company specific, not a sector specific. Now, if you see the second quarter, now that was weak and marked by because of 3 factors, that is higher crude prices, weaker rupee and lower ticket prices. Now, these factors led to massive losses for all the 3 listed airline companies in India. In fact, the combined loss reported by these 3 companies was more than 2,600 crore rupees in the second quarter of financial year 2019, which is the highest seen by these 3 companies in the last 3 years. That is since the listing of Indigo on the stock exchanges. Now let's see what was the impact of each of these 3 factors that led to this massive losses in the second quarter. Now first was the crude prices. Now if you see, ATF prices were higher by nearly 41% compared to last year, because of which the fuel cost increased. Now for Indigo, it increased by around 41.6%, which is largely in line with what the ATF prices were. For Jet Airways, it increased by 44.4%. This is despite the fact that they have more capacity deployed on the international route, which enjoy lower taxation. So this was a higher increase for Jet Airways. And for SpiceJet, increased the most, that is 47% compared to last year. Now this could be because of their older planes, which led to higher fuel run. Their fuel cost per seat kilometer increased nearly 47%. Now ticket prices were lower because of competition in the second quarter, and that has impacted the yields of this of all the 3 listed airline companies. And for Indigo, it impacted the most. Now yields, which measure the average earning per passenger per kilometer, now that declined nearly 10% for Indigo, and it declined the most for Indigo. That could be because they have deployed most of the capacity in the domestic airline in the domestic aviation sector. Now for Jet Airways, it declined only by 6% because of the international routes, which saw a good ticket pricing environment. And for SpiceJet, it declined the least, that is only 3%, and that could be because of their regional routes. The SpiceJet's yield have declined only by 3%. Now rupee depreciated by nearly 9% compared to last year. So let's see what the impact was on the aviation companies. Now because of this 9 rupees rupee depreciation, Indigo's forex loss, now that rose nearly 7.3 times. Jet Airways foreign exchange loss increased nearly 5.7 times, and that of SpiceJet increased 5 times compared to last year because of this 9% rupee depreciation seen in the second quarter of financial year 2019. Now the non-fuel cost. Now if you see that here, SpiceJet has been impacted the most. SpiceJet's non-fuel cost per seat kilometer, now that increased nearly 15% compared to last year. Indigo's increased by nearly 13.5%, and Jet Airways increased the least, that is close to only 9%, and that is because of the cost saving initiatives that the company has taken. Its non-fuel cost has increased only by 9% compared to last year. Lastly, let's see which company has managed to stay in green operationally despite these negative factors. Now, and that was Indigo. Now, Indigo's EBITDA, which is one of the key profitability metric for an airline company, was still in positive and close to 111 crore rupees in the second quarter. Because of these factors, it has come down from 1600 to 1100, but still in positive for Indigo. While that for Jet Airways and SpiceJet, if you see, their EBITDA has come down to negative 272 crore rupees and negative 44 crore rupees from a positive 850 and 400 crore rupees in the last year.
Interesting. Sumit, thanks for putting that into perspective. And I was just wanting to ask Sumit if there are silver linings, because somehow after the falls that we've seen, the stocks have managed to stabilize because of the crude price fall. Maybe that is one silver lining for these companies despite the torrid quarter.
Rupee is still at an elevated level, if you see. So that is one part of the cost which is still not improved for them. And higher crude prices and a weaker rupee are a factor, but then in the past, if you see, they have been passing on this cost to consumers by increasing the ticket prices, but that has still not seen any improvement. So that is monitoring the ticket prices would be an important factor for these aviation companies, which have still not seen any improvement. So we'll have to see how that pans out for them in the second quarter or in the third quarter of financial year 2019.
Yeah, well, let's wait and watch if the average cost of crude comes off from whatever it was in quarter two to, well, maybe 71, 72. Is that a net positive? We'll get to know when we get to know about it. But Sumit, thanks for putting that into perspective. That's an analysis of the aviation space. And you know why today? Because if you look at the last couple of days, I think the aviation stocks have done really well. So important to highlight what's happened in the quarter gone by. It's also important to highlight what's happened to Vodafone Idea in the quarter gone by, and what's the announcement that has come in. They're going to raise about 25,000 crore rupees through various methods. The move is prompted by the terms of agreement, which states that the combined debt should be brought down. Now, you know, I won't dwell too much on the good and the bad, but just look at the numbers. The news, they're looking to raise 25,000 crores, which will help them pay the debt, which is currently at about 1.12 lakh crore. Yes, you heard me right. This, if they manage to do it, and I'll tell you why I'm saying if they manage to do it, but if they manage to do it, then this will lead to an equity dilution of 41%. The deal likely to be completed by Q4 FY19. Now, how would this happen? Assuming it's a preferential issue, and there are issues with that as well, but I just want to still dwell upon the numbers that we have right now. Assuming that this goes ahead as a preferential issue, who puts in the money? Vodafone Group, about 11,000 crores. Aditya Birla Group, about 7,250 crores. Public, 6,750 crores. That leads to 25,000. My question is, if it's not a rights issue but a preferential, where would this 6,750 crore rupees of equity money come in for Vodafone Idea at a time when it is looking so stressed? So that's the key question, whether it's a preferential issue or it doesn't become a rights issue. Now, for more money that Vodafone Idea would need, because, and I'll tell you why they'll need more money as well. Let me first, bear with me for the announcement. For more money, Vodafone Idea may have to sell fiber assets. The move will essentially add some flexibility to the balance sheet. Now, why I said that they will probably they need more money as well, just look at these numbers, the debt and the leverage scenario, current and post a successful fund infusion. I'm using the term successful very carefully. FY19 annualized EBITDA, that stays the same. I don't think that changes. But the net debt from 1.12 lakh crores comes down, yes, but comes down to 87,500 crores. And the number, while it may look large, the numbers, the ratios, the net debt to EBITDA, 24 times currently. Even after such a large equity dilution and fundraise, it will go down to 18.5. These are seriously large numbers, and this could have some ramifications for an equity shareholder of Vodafone Idea today. I won't be surprised if that happens. People will, at some point of time in the show, we'll also talk about what will happen to some of the other allied pieces as well. Bharti Infratel. Now, how would Vodafone fund this? Will they have to sell stake in Bharti Infratel in order to put the money into Vodafone Idea? And if that were to happen, would Bharti Infratel remain under pressure over the course of the next couple of days or 3-4 days, etc., because of sentiment? All of those pictures come into equation. For Vodafone Idea individually as well, just taken the liberty of highlighting some numbers here. The Q2 numbers came out as well, incidentally. Revenue numbers, net loss being high, EBITDA margins, ARPU, all of that is fine. The point being, their numbers are looking enormously lower on all parameters compared to their nearest peers, which is Jio as well as Bharti Airtel. Data usage, MOU per subscriber, Q2 ARPU, all of them lower than Bharti as well as Jio. So there are some issues that Vodafone Idea faces, and the fund infusion is probably one way to try and solve those issues. Whether or not they can do this successfully, time will tell, but it will have some pressure on Vodafone Idea as a stock today. I dare say even Bharti Infratel in the session today. Do watch out for both of these names. Okay, the third piece on First Word, a global equity rout coupled with domestic macro concerns prompted foreign portfolio investors to pull money out of India for a second consecutive quarter. But there are a select few names where they are committing more money. Yash Upadhyay is standing by with a list of stocks where FI holdings have changed dramatically, both on the upside and the downside. Yash, morning.
Morning, Neeraj. So what we've done is that for the purpose of this analysis, we start with the BSE 500 as the universe of stocks, and we've added the filter wherein stocks that have seen FII holding increased by 0.5% or more, and that brings us to a number of 93 stocks wherein foreign investors have increased their stake, which is about 18.6% of the whole universe, and 123 stocks wherein investors have in fact trimmed their stake by 0.5% or more, or almost 1/4 of the universe. But in terms of which are these stocks that have seen an increase in holding, we start with AU Small Finance Bank. There the promoter holding, there the foreign investor holding has gone from 10.23% in the June quarter to 20.63%, so more than doubled over the course of the quarter. Among the other top names comes Zensar Tech, Mahanagar Gas, Tejas Networks, as well as Greaves Cotton, all of which have seen the promoter holding almost increase and go up to double digit in case of Greaves Cotton as well. The stocks wherein the FII holding that has gone down, they include the likes of Vodafone India. There the foreign investors have reduced their holding by more than 13%, so from 26% it's gone down to 12.35%, along with the likes of PC Jewelers, Balrampur Chini. Punjab National Bank is in fact the stock with the lowest foreign investor holding in this list, with just 3.72% from 8.5% in the June quarter, and followed by Manpasand Beverages.
Okay, now Yash, let's talk about those stocks where the foreign investors are putting their money on, and the analyst ratings on those stocks, and what could be working for these companies.
Right. So AU Small Finance Bank, as I was mentioning, almost 10 out of the 15 analysts tracking the stock, they have a buy rating with a return potential of 30.1%. It recently got included in the MSCI Small Cap Index as well, and we saw a big uptick in yesterday's day of trade. Zensar Tech, 8 out of the 11 analysts tracking it have a buy rating. Mahanagar Gas, Tejas Network has a 100% buy rating. 6 out of 6 analysts have a buy rating and has the highest return potential as well, 47% there. And Greaves Cotton, 6 out of 9 analysts have a buy rating with a return potential of 26.8%. Now let's try and understand what's working for each single one of these. For AU Small Finance Bank, it has seen a strong growth over the last 2 years, almost a 42% CAGR growth, led by increased penetration and gaining of market share from the informal sources and NBFCs. The underpenetrated market and customer-oriented business that would help the business in expanding going forward. For Zensar Technologies, the continued focus in its core services business, that is the key trigger going forward, along with strong momentum in the digital business segment. Almost 43% of its revenues come from the digital services business, along with large deal wins and a revival in the IMS business. So that would be the key growth drivers going forward for the company. For Mahanagar Gas, the city gas distribution business, it is monopolistic in nature, and the company enjoys exclusivity in Mumbai, Thane and Raigad. It plans to expand its distribution network by bidding, and is in process to bid for 20 out of the 86 areas on offer in the 9th round of by the PNGRB, and has set out a capex of about 300 crore rupees to that tune. Along with that, the government's potential move to include natural gas under the ambit of GST, that would be a key positive for something like a Mahanagar Gas. Tejas Networks, the industry it augurs to, has seen an exponential growth in data traffic, and it is well placed given its strong portfolio of optical and data networking products. It operates on an asset-light business model and has an edge over its global peers, given that it has a preference when it comes to the government and large PSU orders on account of the Make in India initiative. And lastly, when it comes to Greaves Cotton, well, there has been a significant focus on cost rationalization. The company has managed to keep its costs under pressure, under control, and it has been expanding its business in the aftermarket sales as well. And with its recent acquisition of Ampere, it plans to scale up the proportion of B2C business as a whole of its product mix. So these are the key positives when it comes to Greaves Cotton.
Well, interesting. Yash, thanks for putting that into perspective. So some companies where FI holdings have changed dramatically and some reasons thereof. During the course of the next few days, we'll also try and get updates on what FIs have done with select sectors, NBFCs, for example, and what's the holding change there that has happened, or some of the other small caps in which there could have been changes, because there are some small caps which are held efficiently by FIs over the last couple of years, but that'll come a bit later on. For today's session, after these pieces of analysis, let's also hear out from our management that came out with numbers as well. Indian Hotels reported a strong growth in the first half of this financial year, and it expects to continue the momentum. The Tata-owned hotels chain, in fact, looks to expand margins by 800 basis points by 2022. How do they plan to do that? Sajid Mangat put that question to Puneet Chatwal, the managing director and CEO of the company. Listen into what he had to say.
The 800 basis points are just built on a normal growth in the RevPAR and the basic fundamentals in the industry, but becoming more efficient, having more management contracts, more fee-based business, which helps to increase your margin, monetization of some of our assets in secondary and tertiary markets, monetization of other pieces of real estate or land banks that we have collected over the years. This should help us in the 800 basis points. Anything which could be considered as a tailwind, especially on the side of the rates, has not yet been factored in. And there is a reason for that. The reason is in the last 10 years, the rates have declined, even without accounting for inflation. So there is only
primarily because of supply, right?
Primarily because of supply. I think in the aftermath of Lehman crisis, what happened after 26/11, and as you said yourself, the supply increase was faster than the demand increase. So a lot of factors have led to kind of a rate decrease. It's not even a stagnation in the rates. So there is only one exception to that, and that is the Goa market. The Goa market, the rates have increased by 25%, but there are many markets, important markets in India, where the rates have decreased by 20 or 25 or 27%.
Can you name some of the markets?
Bangalore, from its peak of 2008 to days, Chennai is the second one. So Delhi is not doing better either, and neither is Mumbai. So the rates of 2007-8 were much higher than they are today.
But if you look at last 4 quarters, are you seeing the average room rates going up gradually?
Gradually, but at a very slow pace. I think they will eventually go up because markets
you think it's a sticky thing, right? It's, rates going up, it's a sticky thing. It's very difficult to push the rates up in this market, or even though operating metrics for the industry is somewhat improving?
I would have preferred if you would ask me this question in 10-15 days from now, because this year the Dussehra and Diwali have come in the most important half of the year, because second half is when we have almost 65% of the total year's revenue coming in. So as we just finished with that holiday weekend, and we are only 2-3 days into the normal working, we don't have the full visibility. But I remain confident that the markets are strong, the fundamentals are strong, the occupancies have gone up. They're coming to the same level as 2008 for the Indian market.
Which is 80 plus?
No, it's around 2008, the Indian market occupancy as per Hotel Evate was at 68.8%, and now we are almost hitting 68.
For Indian hotels?
For Indian hotel market.
For Indian hotels
for
company?
Indian, not Indian hotels company, but for the Indian hotel market in general. So once the occupancy gets back, the trend internationally in this business has been then the rate starts to follow. So we have not yet witnessed it in that kind of form, but I think the next few weeks will be decisive on that front.
And how are occupancy rate for you? How has it been?
We have done quite well. We have in the first
gone above
half,
68, above industry.
See, the industry in India has gone up by 3.7%, again as per the same source, and ours have gone north of 8%. And that is the RevPAR growth. And the majority of it has still been driven by occupancy and not by rate. So I think that upside we will see. On the other hand, I have to say that a majority of our portfolio, especially with the Taj brand, is coming at a very high base. If you're in a mid-market or a kind of a upscale kind of positioning, the probability of getting a much higher rate increase is higher. But if you're selling a palace or if you're selling a safari already at those kind of prices like we do, then the rate increase in a percentage level will not be that significant.
Okay, your pipeline also has gone up by nearly 90%, right, over last year.
Correct.
You have a target of achieving 25,000 rooms by 2025,
Correct.
if I'm not wrong. How do you plan to achieve that? There has been a couple of properties which you have gone into in the last 1 year or 6 months, 15 odd properties which you have done. But as you go forward, what is the kind of business mix which will be there, ownership versus management contract?
I think our ambition is to have a balanced portfolio so that our owned and leased portfolio is 50% and the 50% is managed portfolio. We don't want to be only a fee-based business company. I think the kind of leverage and the kind of profitability we have from some of our owned assets like the Taj Lands End, or we are sitting right now in the Taj Mahal Palace and Tower in Mumbai, you need like hundreds of franchise or management contract to come to that level of income. So I think we are going into fee-based growth more to increase the margins, so we have a more balanced portfolio, so we are better hedged in volatile situations when the markets go down, and I think that's a good way forward for Indian Hotels Company.
And which are the segments where you see that kind of margin expansion coming in, because you have multiple segments within?
So you can expand margins in any kind of segment, but the highest margin you can achieve is at the bottom of the pyramid. That is with the Ginger brand.
And you've been expanding Ginger as well.
We have been expanding
Ginger
aggressively. We have revamped the Ginger brand. The launch of the new Ginger digitally has already happened on the website, and physically is happening next month with our existing Ginger property in Panjim in Goa. So after that, Whitefield in Bangalore will come. So we are very confident that Ginger will be very attractive brand for the majority of the people on the Indian subcontinent. But at the same time, when the markets bounce back, then our ownership position in many of our assets will help us really grow the margins, especially if the markets were also bouncing back on the rate.
Well, I dare say you can expect this stock to react a bit today because the numbers on the EBITDA level looked extremely important, extremely positive. So let's wait and watch what happens to Indian Hotels in the session today. Well, that brings us to the end of First Word, but lots more lined up on IndianOpen. We discuss opportunities in the Indian and the global equities with top minds at CLSA. Mahesh, Nandurkar and Chris Wood join in post 9 a.m. These are conversations that you can't afford to miss. But after this break, though, a full tilt towards the immediate day's trade. Stay tuned.
Good news, got a promotion and a damn good raise.
Congrats बेटा.
वाह, रेज अब तो इंश्योरेंस पॉलिसी ले ले.
कौन सी कंपनी से लूं?
चूज वही जिस पर हो पूरा भरोसा.
That's good. But आज की generation wants everything online. Easy premium payment options, loan facilities और wide range of products.
पापा दीदी, I will decide. Just send your links now. तुम दोनों भी ना. Same choice. LIC.
LIC trending with times. 62 सालों से हर generation की पसंद.
It's not about the award. It never is. It's about what went before and what came after.
It's about getting recognized for the trust and confidence the customer has shown on us. We actually strive for it.
It's about the brightest ideas and cleverest implementations. It's about innovation.
It's about impact for manufacturers and help for shoppers. Tangible, meaningful impact for manufacturers who innovate, and genuine help for shoppers looking for the best new things on the shelves.
It's not about the award. It is about standing out. It's about being a giant even if you're really, really small. It's about picking the leaders of tomorrow, today. It's not about the award. It's about competing.
It's about an unbiased, countrywide, face-to-face consumer survey that is unique and provides relevance and differentiation. Essentially, we're adding something to the marketing arsenal of product teams.
It's about doing one's best and raising the bar each time.
So it's about the end customer. If you have that clarity, what is this need that you're trying to solve for the end customer?
About exceeding expectations. About going all in. Coming. Product of the Year.
It's about feeling good that we are associated with Product of the Year. This is our 10th year.
30 years of finding brands that capture $1 billion.
Thanks for tuning in to Alpha Moguls, a show where we speak to some of the finest investing minds about how they are approaching investing in the current scenario from the medium to the long-term perspective. Our guest today is Samit Vartak of Sage One.
I have much more confidence in probably assuming that in the next 3 to 4 years, their earnings will double. And given the valuations, generally there is very little chance that the valuations will get derated over that period of time. Just forget about the price you bought at. Just look at forward. Which are the stocks which will deliver going forward? The private CapEx cycle is where the profits come through.
Welcome back. You're watching Indian Open right here on Bloomberg Quint. Let's see how the Asian markets are faring at this point. It's a mixed bag, but with a bigger tick of green for a clutch of names. So the Shanghai markets are up about 0.67%. Hang Seng is following suit about 0.33%. Nikkei may be slightly off. The SGX Nifty is indicating about a start of 0.25% in the green. So it's not all bad. We may actually start off on a good note. A quick analysis of what's happening in the derivative space as well, especially in trade yesterday, because I did see banks and private sector banks and PSUs do very well. But let's go across to Agam to try and figure out how the overall setup is looking like. Agam, morning.
Good morning, Neeraj. You're absolutely right. We did see longs in the banks, but that perhaps was one sector which stood out. Now, let's start by taking a look at the Nifty futures. And we did see some amount of unwinding, despite the fact that the Nifty remained flattish. But coming down to the Nifty banking futures, that's where we saw longs. And this was largely on account of the Nifty PSU banking names that had led the index higher. We did see about 6% increase in open interest towards longs. Moving in, when it comes to the India volatility index, okay, first when it comes to open interest change, as you can see, there really isn't too much to speak for except for unwinding in the 10,300 put, and we're a little more writing on the higher level calls. But let's move on and take a look at some of the other variables, and perhaps if we can bring in the India volatility index, that's seen a little bit of an up move around, well, less than 1%, still hanging between the range of 18 and 19. Let's move on and talk about some of the other variables. You have put call ratio for the Nifty at around 1.57 against 1.6. And also in terms of stocks which are in the band, we have Adani Power and Jet Airways. So watch out for these. We're expecting restricted trade there. When it comes to open interest gainers, we are seeing a lot of activity in Kaveri Seed Company, Siemens and Ashok Leyland. All of them slipped in trade and all of them saw increase in open interest towards fresh shorts. Interglobe Aviation was the other one where we did see longs considering a 23% increase in open interest. In terms of unwinding in stocks, well, Divi's Labs were the one where we saw longs unwind, but considering a climb for Jet Airways and Allahabad Bank yesterday, those were some of the stocks which saw short covering coming through. Again, mixed cues, and we're likely to see mixed cues continue in today's day of trade, considering the kind of earnings that we've seen, which of course we will talk about a little later on in the show, Neeraj.
Well, thanks a lot for that, Agam. We'll talk about some of these as well and talk about them fundamentally as well as technically. Let's start off with the fundamentals. Parthiv Shah, director at TRACOM Stockbrokers, joins us right now on the show. Parthiv, good having you as always. Thanks much for joining in. Parthiv, just a bunch of stocks in news, and I want to start off straight off the bat with the one that I was speaking about, Vodafone Idea. The results notwithstanding, the massive equity dilution that they are proposing to bring down that mountain of debt. Now, what does this mean for an equity shareholder who's currently holding the shares of Vodafone Idea?
Good morning, Neeraj. Neeraj, unfortunately, not only for shareholders of Vodafone Idea, but I am also slightly concerned in terms of shareholders of Grasim. Grasim holds around 11% stake in the combined entity. And certainly, I think with the equity dilution and Grasim being more like the parent from the Aditya Birla stable, I think their minority shareholders also won't be probably a very fair call, but that is something they'll have to bear with. And as such, Grasim is having around 7,000 crore worth of capex in their core business, which is VSF and caustic soda, caustic chlorine business. And over and above that, they have just 1,000 crores of net cash. So some reading out there as well. But coming back to Vodafone Idea, it's a very, very unfortunate situation. Despite the merger and talking all about the synergies, the net debt is still hovering at around 1.1 lakh crores. They have talks about hiving off their fiber business, which is again a nice asset to own, but they don't have option. And at around 84 rupees ARPU, I think despite the fact that there's so much of traction, sometimes I wonder the telecom sector is going through like what's happening in the aviation sector. There's a lot of demand of data, a lot of growth, but there's no pricing power. And that is purely thanks to Reliance Jio's entry. Ever since that, we have seen the entire telecom carrier business change. But not writing off that fact, what my sense is, there's still going to be pain for next at least a year. Till Jio is done with its predatory pricing, good senses might prevail and rationalization of prices will take place. At that point in time, this synergy of Vodafone Idea will certainly work for the shareholders. But for now, it's a total avoid. I would rather buy this company at a 20% premium, but only with the visibility that now the pricing power is back and the synergies will play out. Because sometimes we know these telecom synergies take almost 2-3 years to play out. So it's a total clear-cut avoid in terms of an investment call in Vodafone Idea.
You're saying that if somebody has the share, should get out as well. Just a follow-up question, Parthiv, on Bharti Infratel, because if Vodafone is to subscribe to the preferential issue, they'll need to raise the money via maybe stake sale in Bharti Infratel. Is there allied pressure that you expect on that stock too? And would you use that pressure to buy into Bharti Infratel?
See, certainly there would be some pressure, but I think Bharti Infratel has a totally differentiated business model. I think we are moving from 4G to even 5G going ahead. And I think in all these segments, I think the use of tower and the real estate of owning a tower is always going up, and the rental yields are also going to eventually move up. No doubt currently these carriers don't have much pricing power, but as I mentioned, after a year or so, we are expecting after this humongous consolidation in this space, some sort of pricing power, rationalization of pricing power to come back. And that's the point in time where players like Bharti Infratel, I think they're certainly going to benefit. So I'm not terribly bearish on the tower real estate space. That's a nice annuity sort of a business model. The stock has massively corrected. The dividend yield looks attractive. So I think if one has a 2 to 3 year horizon, then a play like Bharti Infratel or any such equity selling news, I think might be a good entry point.
Well, let's wait and watch. 260 for Bharti Infratel. I'm keenly watching out for both of these names in the session today, as I'm watching out for Kotak Bank, because ING Group plans to completely exit Kotak Mahindra Bank. At least sources tell Bloomberg Quint that ING might put that entire stake, which the entire remaining stake worth about $1 billion through block deals. Yatin Mota is standing by with more details on that. Yatin, what are you learning?
Well, Neeraj, if you remember way back in 2014, ING Vysya Bank was merged in Kotak Mahindra Bank, and the ING Group got nearly 6.5% stake for that. Of course, few years back, ING sold 2.5% stake, and now they have close to 3.73% residual stake, which is there. What we gather from reliable sources that as early as this week, there could be a transaction wherein ING Group would be exiting its holding in Kotak Mahindra Bank. At current market price, the stake is valued little over $1 billion. They hold nearly 7.11 crore shares in Kotak Bank. So at the current market price, it's nearly $1 billion. Of course, the sources that we contacted indicated that everything depends on the demand situation. There could be tranches of block deal which could happen given the fact that the market conditions conditions are quite volatile, getting institutional response and the demand would determine the pricing as well as the timing of the block deal. Also, what we gathered is that the ING group has capital requirements back home, and probably this is the reason why they want to exit their investment in Kotak Mahindra Bank. And when we contacted ING, they said that they will not comment on market speculation and rumors, and that was their comment with respect to the entire story that we have.
Well, this comes in at a time when Uday Kotak needs to cut his stake in the lender to meet RBI guidelines as well. Does this pose some additional challenges?
So, Neeraj, that is the key reason for, the underperformance. Remember, RBI wants Uday Kotak to reduce the promoter holding in Kotak Bank to 20% by December 2018 and by another 5%, which is to get down his promoter holding to 15% by 2020. So we have a huge supply of paper which is there in Kotak Mahindra Bank. At least, what reports are indicating that Kotak always is in engagement with RBI in order to get some extension. But if they do not get extension, this will be probably, a month, or probably by December we could have a series of transactions which could take place in order for the promoters as well as ING to cut down their stake.
Well, let's wait and watch what happens. There is an overhang for sure on Kotak Bank stock price, and it's visible in the way the stock is behaving. I think thanks for bringing us these exclusive details. Well, a deal likely to happen sooner rather than later. Parthiv, actually come in on this one. Yesterday we saw some of the private banking stocks do rather well, and a lot of them in news. Kotak, for these reasons that we learned from our sources. Yes Bank, Ashok Chalwa stepped down. I don't know what kind of material impact on the stock it has, but there's a bit of a spanner in the wheel, so to say. And the performance of a Kotak and an HDFC versus an Axis and an ICICI Bank. What do you do in this large private sector banking space currently?
See, firstly on Kotak, and as a disclosure, we do own Kotak in our long-term portfolio, Neeraj. And my sense is, and it's kind of fingers crossed, that whatever may be the reason for the stake dilution, the best reason for the current shareholders in terms of the stake dilution of Mr. Uday Kotak should come with the fact that there is some sort of equity swap deal wherein there is some sort of inorganic growth opportunity for the bank. I would hate to see that Mr. Uday Kotak takes his cash and cashes it and takes the money, because I think eventually then that will lead him to invest that huge chunk of money into some other business wherein his energy or focus might get diverted. So of course he's a very mature seasoned banker, and I shouldn't say this, but still I think that's one worry I have as a shareholder. So what my sense is that if it's a nice inorganic growth opportunity, as a result of which the equity gets diluted, I'm not at all worried. We have seen their past track record in terms of inorganic growth. They acquired ING Vysya, turned it around, and I think now it's very value accretive. So I would love to see the balance sheet scale up with some sort of inorganic acquisition. That's all speculative right now, but yes, any sort of declines from here, I would love to buy this franchisee. I'm not betting on a short-term news-based event. Long-term story looks excellent. One reason why I think in the past we did talk about some corporate sector banks, especially ICICI Bank, in terms of its CASA. I think I mentioned in the past that, like cash is king. Here for the banks is going to be CASA being the king. And I think ICICI has a nice chunk of floating rate loans where the rates have inched up, and with a very stable cost regime. We saw, I think operationally, this was a fantastic quarter. The slippages run rate was a lot lower as compared to what the street had penciled in. And no doubt, I think ICICI landed up doing very good. And even at current levels of 368, if I were to subtract the valuation of its subsidiaries, the core business is still available at around 1.7 times price to book, which is not extremely pricey. If any sort of NCLT cases like SR Steel were to fructify this year, then probably I think market would be willing to pay it a higher price to book multiple. So I think on any declines, ICICI Bank does make sense.
Watch out, the stock is trading at near record highs, is ICICI Bank. Well, lots more to talk about, but let's get in our research team, which is standing by in the huddle to talk about all the key stocks and news. I believe a bunch of weak results, some set of good numbers as well, and some stocks and news, all of which will be monitored. But quick reactions from Agam, Nikki, as well as Yash to talk about all of these three. All three, thank you so much for joining in. I saw a bunch of weak results. I want to start off with those first. Yash, to you first.
So more than weak, they are an inline set of numbers. So we'll start with Thermax. That one reported a 38% growth on its top line, coming in at about 1,400 crores. A net profit growth of about 30%. However, margins contracted by about 150 basis points. Future Retail, a 9% uptick in revenues. A net profit saw a 14% growth, but again, margins seeing a bit of an improvement, about 30 basis points there. Grasim, inline set of numbers again, 23% growth in the top line. Net loss, however, of 1,446 crores. Now, this is on account of an exceptional loss in the current quarter of close to 2,300 crore rupees. Margins, they have contracted to 15.2% versus 18.6%. Infibeam revenues grew by about 47% to 135 crores. However, the company reported a net loss of 4.5 crores versus a net loss again in the same quarter last year, and a 45% surge in their payment gateway charges, coming in at about 107 crore rupees.
Well, let's wait and watch what happens to some of these names. Thermax, I thought the margin disappointment was quite stark. Let's see if it reacts accordingly. Yash, thanks for putting that into perspective. What about you, Agam, the stronger ones?
Yes, so well, United Breweries clearly the outstanding one here, considering we have seen a rise in 19% in revenues. EBITDA margins were rising to 20.8% against 17.3%, and net profits consequently rose 74% to 164 crores. And both the top line as well as the bottom line numbers are ahead of our consensus expectations. Indian Hotels, a surprisingly good quarter considering a 13% rise in revenues. It's made a net loss of 5 crores against a loss of 58 crores year on year. And do remember, had we not seen an exceptional loss of around 45 crores in the current quarter, this number could have been a profit number. And finally, Ujjivan Financial Services, net interest income has risen 34%, profits at around 44 crores against a loss in the previous quarter at 12 crores. And we've also seen your net interest margins improve at 12% against 10.6%. So these three stocks can expect to open in the green today.
Okay, we'll watch out for some of these names as well. Thanks for that, Agam. What about the stocks in news, Nikki?
Bunch of them that we're tracking this morning. I'm going to start off with Bayer Crop Science, where the company is, the board has approved a proposal for amalgamating Monsanto with itself. The shareholders, the company will be issuing 2 shares for every 3 shares held in Monsanto. Tata Power, where the JV has signed a pact to acquire 75% stake in Prayagraj Power Generation for around 6,000 crore. Yes Bank again, as we mentioned, that non-executive chairman is resigning with immediate effect. Dhanuka Agritech, where the company has approved a buyback approval for around 13.12 equity in the company at a price of 550 per share. Now remember, that's almost a 30% premium from the current market price. NHPC board has approved a buyback for more than 2.5% equity at a price of 28 per share. That's pretty much in line with what the current market price that we saw as of closing yesterday. Jet Airways, importantly, 2 bits of development there. One where a Times of India report says that the Tata Sons chief is going to be pitching for board's backing to acquire Jet Airways. Is going to be presenting the viability plan there. And ET development which says that Tata SIA Airlines will be eyeing an all-stock merger of Vistara with Jet. That's again one bit of development we'll get to keep an eye out. Gujarat Fluorochemicals, where the board has approved the demerger proposal for the chemical business into a separate entity altogether.
Thanks, Nikki. Thanks for putting that into perspective. Well, I'm picking up 2 out of those many stocks and throwing them across to Parthiv. Parthiv, either of these, if you track, one is Gujarat Fluorochem in the demerger of the chemicals division, whether it has material impact or no. If you don't track Gujarat Fluorochem for any reason, any thoughts on United Breweries? The numbers seem absolutely smashing.
I'll talk on both the stocks, Neeraj. Firstly, Gujarat Fluoro. I think this is a great development because I think for shareholders of Gujarat Fluoro, owning stakes in companies like Inox Wind, which has certainly turned around, but still I think it's a drag on the consolidated balance sheet, and also Inox Leisure, which is a decent company. So now with the demerger, I think there's a clear-cut clarity, and the management has realized the way many of these specialty chemical players have re-rated, that having a core business with only the specialty chemical, here in case of Gujarat Fluoro being the PTFE business, and most importantly, it's not only about the PTFE, polytetrafluoroethylene, but they are going more downstream, the value-added products, and some products which are manufactured by players like DuPont, Solvay, Daikin. So I think they are going into the specialty products. They have hired engineers from places like DuPont, and I think they are really working very hard to get approvals of these products. Some of the products have already gotten approval, and we are seeing the expansion in the margins. So going ahead, we are very bullish on the PTFE and the fluorine polymer chemistry that they are moving ahead with. The capex is almost done. There could be some 100-200 crores worth of capex, but on a standalone basis, the company is almost at a debt-free level. So we are very bullish on this story, and definitely the valuation is not very rich at current basis. And 2-3 years down the line, I think this company can really scale up. Talking about United Breweries, I think it's a fantastic number at 17% volume growth versus the street consensus of 8 to 9%. And that too knowing the fact that in places like West Bengal and Maharashtra, there was steep increase in taxation. I think despite that fantastic numbers, there was a huge expansion in the gross margins thanks to the premiumization strategy, especially Kingfisher Ultra and the Heineken brands that they're selling. I think overall it's a fantastic set of numbers. Valuations are rich, but I think with such numbers and such commentary going ahead, I think things are looking extremely good for shareholders of United Breweries.
I dare say a conversation to monitor today, 10 a.m. on Bloomberg Quint Live. Shekhar Ramamurthy will be talking to us, so do tune in for that. However, 8:50, in fact, a few minutes over than what we usually get to. But let's get in quick technical perspectives from our experts. Ruchit Jain, technical analyst at Angel Broking, joins us on the show, as does Aditya Agarwala of Yes Securities. Both of you gentlemen, good morning. Thanks for joining in. Ruchit, I'll start off with you. How are you approaching trade today?
Very good morning, Neeraj. Neeraj, if we see Nifty since last 2 weeks, then it has traded in this broad range of 10,440 to 10,700. Now, positionally, on 2nd of November, we had seen a gap up opening in Nifty, which was around 10,440. And in the correction during this week on Monday, the 10,440 gap area has acted as a support. Whereas on the higher side, the resistances are in the range of 10,750, 10,800, where the 200-day moving average support is placed. So we believe that this 300 to 400 points range has been formed in Nifty. In next few trading sessions, the market is likely to trade range bound, and there would be more stock specific momentum within this range. Now, if I have to trade in the index front, then my stop loss from here on is 140 points lower, which is below 10,440, and my target too is around 140, 150 points on the upside, which is around 10,750. So the risk reward ratio is not that favorable that one should take a trade in Nifty at current levels. Wait for if any kind of dip comes around 10,500, then I think 500, 520 range, then only the risk reward ratio would become favorable to create fresh longs. Okay. So as of now, we are advising our clients to focus more on stock specific ideas where there are better trading opportunities available.
Okay. Is there a Nifty trade, Aditya, today? Good morning.
Good morning. I would agree with Ruchit. Nifty has entered into a consolidation zone. So 10,700 to about 10,750 is acting as a resistance on the Nifty right now. So I would also take a trade above 10,700. Probably that would be so 10,650 is the immediate resistance. If it crosses, probably there could be a day trade in the market. I would go long above 10,650. Targets out here would be very small, 10,700 to about 10,750, because again that happens to be the recent highs from where Nifty saw that sharp sell off. Okay. So 10,700 to about 10,750 is that resistance which I would want the Nifty to cross and close above.
So then you're focusing on stocks then? Okay.
Yes, it's more of a stock specific. Yeah, sure. So my first buy idea is SBI. So if you take a look at the banking stocks have been holding on. SBI was one of the top gainers in trade yesterday. So I've picked up SBI in trade today. I'll go long in SBI at current levels for targets of 298. We'll keep a stop at 277. Then another idea is a sell idea. It's in the IT space. So IT has been witnessing some correction of late. Yesterday, all the IT stocks saw some sell-off. So TCS is looking weak on charts. One can go ahead and short the stock at current levels for targets of 1780. I'll keep a stop at 1910. The IT pack is looking slightly weak, and there could be some more correction before we see a bottom and then an up move. So sell in the IT pack.
Okay, two large caps, and Aditya is following the trend seemingly, because banks is buying and SBI is his call. IT is selling, and TCS, one of the calls. Ruchit, what about you? Your ideas for the day?
I have a buy recommendation in Jubilant Food. This is purely from a trading perspective of next 3 to 4 trading sessions. Recently, the prices had formed a lower low, but RSI had shown a positive divergence. So we expect this pullback move, which has been seen in last 2-3 days, to extend up to its 200-day moving average, which is at 1250. So one can go long in Jubilant Food from a trading perspective, stop below 1110 and target of 1250. Pidilite is another stock which I have on my buy list because of the outperformance that it has been showing in last 2 weeks. The up move has also been supported by good volumes yesterday. So this up move could extend further. Even the momentum readings are showing some positive traction. So one can go long on Pidilite with stop below 1065 and target of 1145. And I too have a IT stock on my sell list. So KPIT Technologies. If I see the pullback move which was seen in IT during first week of November, KPIT has not participated in that pullback move. It has rather shown an underperformance and is consolidated in a range. So if IT PEX corrects, then KPIT certainly because of its underperformance could correct further from current levels. Go short in KPIT Technologies futures with stop loss about 218 for target around 197.
Okay, interesting. Viewers, so those are some ideas. Do stay tuned, of course. In about 6-7 minutes or 8 minutes from now, you will start hearing from the CLSA think tank. Both Mahesh Nandurkar and Chris would be joining in on our feed to talk about what they believe the markets could do in the near to the medium term. So you have to stay tuned for that. But it's time for a special segment, Bloomberg Edge. In fact, even there, coming in slightly later, but Yash Upadhyay is finally here with what the Bloomberg terminal has thrown up on a stock today. And Yash, I believe the stock on your radar is Divi's Lab.
That's right, Neeraj. Good morning to you. Divi's Lab, well, a sell call coming in on the base of, on the back of a bearish engulfing pattern being formed on the charts. Let's first try and understand what the indicator is. A bearish engulfing pattern is formed after a bullish candle is followed by a bearish candle, wherein the size of the second candle completely engulfs the one of the candle ahead of it, and the longer the size of the candle is, the greater is the evidence of a top forming and prices coming under pressure. As we could see on the chart with yesterday's move over here, the big red candle that completely engulfs the size of the green candle ahead of it, indicating that there could be further weakness coming in into the stock.
Well, has this worked in the past beautifully for Divi's Lab, Yash?
Absolutely, Neeraj. In fact, 7 out of the 9 times it would have given you positive returns on an average of more than 6%.
Okay, interesting. Yash, thanks for putting that into perspective. That's Divi's Lab. Aditya, you want to come into a quick thought here on Divi's Lab? Would you take a trade here?
I would agree with Yash. There is weakness in the stock, no doubt about that. There is a negative divergence on the RSI as well. But I would go short below yesterday's low because it's made back-to-back same lows in 2 trading sessions. So that is acting as a support immediately. So 1480 is the immediate support that I'm looking at on Divi's Lab. If the stock starts to trade below that, then there's definitely a short trade which one can take, and targets out here could be as low as 1400.
Keep in mind, so the Bloomberg terminal highlights a trend developing. Then we just thought we'll try and corroborate that if indeed one of the experts believes there's a trade here, there might be a trade at slightly lower levels. Okay, some other stocks in focus. Parthiv, again, I'm stuck to results today, but Indian Hotels and the management commentary as well for the outlook ahead. But the numbers and the margin expansion or the margin pullback that we saw, I thought was quite heartening. What did you make of the numbers?
Yes, indeed, Neeraj. I think the numbers were extremely encouraging, and especially the figure of the revenue per available room was one of the best in past many quarters, and probably even industry-wise. But this stock is quoting very cheap as compared to many of its peers at around 17 times EV/EBITDA multiple for FY20 basis. The only slight concern that the street has is its current debt levels. It's at around 2.5 times the EBITDA, and I think what my sense is that there is no clear-cut roadmap in terms of monetization of some of his properties, which the management had talked about. The encouraging thing is that out of the 50 new properties that they're developing, almost 2 are the capex ones and the rest are low capex ones. But still, I think the debt guidance for FY19 end and FY20 is an incremental in terms of the debt levels. So I think that is where probably the street will be slightly concerned. And if at all the average room rental were to go up and the occupancy were to further improve, and if this company were to get operating leverage, then probably we might see some sort of debt rationalization. That is what we are eyeing at. But anyways, I think the stock is not at all expensive, and one is bullish on this segment. And even the luxury brand has supposedly done relatively better. So I think over a 2 to 3 year horizon, this stock can deliver good returns. And after a long cycle of like bad returns in the hotel sector, we are bullish on hotel sector over the next 2 to 3 years at least.
Interesting. You know, at some point of time, we'll talk to Parthiv about Mothers and Sumi as well, the stock that corrected quite a bit. But since we are with Indian Hotels, Ruchit, a quick view out here, 30 odd seconds, not more. Indian Hotels, if the stock were to start off marginally higher today, is there a trade on the upside?
So Neeraj, last 4-5 months the stock has consolidated in a range, and the entire consolidation has panned out around its 200-day moving average. Now the short-term resistance is around 136. So if we see a positive opening and we get a follow-up move above 136, then one can certainly enter a fresh long, keeping stop loss below 129 and expect target around 145.
Okay, so well, if it opens above a particular level, then there might be a trade out here in Indian Hotels as well. 136, I believe, is what I heard Ruchit say. So do watch out for Indian Hotels. The numbers look good, but it's not a stock that really make those large moves. So you've got to be careful with here. About a trade here, but an investment perspective, might well be worth it. Let's wait and watch. Parthiv certainly believes it is. 19 seconds or 15 seconds to go for the markets to kickstart trade. Do watch out for a bunch of stocks. Asia is trading mixed. The SGX Nifty has indicated a start which is marginally in the green. I would watch out for Kotak. I would watch out for United Breweries, and I would watch out for Vodafone Idea and that whole clutch of stocks. But here's how the pre-open rates are looking. As usual, volatile and a lot of gyrations, a lot of difference between the Sensex and the Nifty. Give these rates a chance to stabilize before we talk more. Bring up, I dare say, Vodafone Idea first, not an index name, but I still want to bring that one up before I talk about some of the index movers. And let's see what's happened there. 5% lower for Vodafone Idea. Why am I not surprised? Let's bring up two Nifty names or two index names then. Grasim as well as Bharti Infratel, and see what those two are doing in the session today. 4% lower for Grasim. The numbers looked weak. There's this Vodafone Idea overhang. Bharti Infratel for now not looking all that bad. Kotak Mahindra Bank, and let's see what's happened there. Yes Bank, let's see what's happened there. Both these stocks under in news. Kotak Bank down about 2.5. Yes Bank a slam dunk. I don't know if it'll be a 10% downtick, to be honest, but yes. Ashok Chawla moving on, saying he can't give time. I don't know how the markets will read it. Frankly, I don't know. I really don't know. It'll be a 10% downtick or whether it'll be a 2% downtick or whether it might open flat. But time will tell. I think the pre-open rates are certainly showing a worrying picture for Yes Bank. Let's give these rates a chance to stabilize. Our OMC is doing what they did yesterday. Let's see what HPCL is up to. Okay, up about 3%, not bad. Let's actually pull up the gainers. M&M up about a couple of percentage points too. Ultratech Cement looks like starting off well. So those are the list of stocks at the large cap end of the market which are in news. Monitor Yes Bank, monitor Kotak Mahindra Bank. Those two from the banking space would be in focus. Ujjivan Financial, I thought, came out with a robust set of numbers. Again, it's a stock under a bit of a cloud, but for now looking like starting off on a good note. I don't know if Infibeam and the numbers there, while they looked okay because some of the internals looked robust, I don't know if the market would really buy this in a big way. It may be showing a 10% uptick right now, but I think people would be wary of going out and purchasing the stock purely on fundamentals, but for now looks okay. Jet Airways 6% higher. As Nikki stated, the TOI reports that the Tata Sons chief is going to make a presentation for a viability test of purchasing into Jet Airways. Maybe that keeps the stock in focus today. 6.5% higher. The fact that crude is off also aids sentiment. Dhanuka Agritech buyback news, and that stock is up about 5%. I want to see what Power Mech, it's a very illiquid stock, but maybe started trading. Let's wait and watch what happens there. Illiquid stock about 1.5% higher. What's not doing well? PC Jewelers down about 10%. Yes Bank stays lower, by the way, 10% lower. PVR has some unnatural downtick. I think this will change, but looks like starting off slightly weak. Let's wait and watch here. Rupee and the bond yields, just very quickly bring those two up as well. After a really remarkable pullback in the currency, 72.08 yet again, a day of strength. And the bond yields at 7.76. Are they at 7.76, 7.73? So a bit of a drop in the yields as well. So then bond markets too have looked a bit resilient with the fall in crude prices. Do we have Mahesh Nandurkar? Yes, India Strategist at CLSA joins us on the show. Over to Devina, who is in conversation with Mahesh at the CLSA conference. Devina, over to you.
Hi there, Neeraj. I'm here at Delhi and at the CLSA conference. With me now is Mahesh Nandurkar. He's the India strategist at CLSA. Mahesh, thanks very much for joining us and taking out the time. You know, I will come to earnings. You recently the CLSA has put out a report and quite a lot of earnings downgrades, but I'll come to that in a bit. I just want your broader market perspective now. We've seen a correction of almost 15%. Market has bounced back from those levels. Up until the correction started, everything was looking fine. It was a bull trend that everyone backed on. But do you think this is just a blip in that bull trend, or that we're turning the corner for that?
Okay, thank you very much for having me here. So we have been cautious on the markets for some time, in fact, for the past few months. And the primary reason for us being cautious on the markets, were some of the risks which actually played out. So we have been worried about the rising interest rate environment in the country. We have been worried about the fiscal slippage. We've also been worried about the rising oil prices and therefore the impact on the currency. So some of those concerns have played out partially. And yes, the valuations have definitely come down from the all-time highs that it has been trading at. But my sense is that we still probably need to kind of see some bit of more sort of correction from the valuation perspective. The process of stabilization, I think, still hasn't happened in my view. We will probably still need to get adjusted to the higher interest rate environment. That's still not fully reflected as yet in the corporate P&Ls, also in the consumption trends to some extent. So my sense is that the next sort of couple of quarters will still be something that we'll need to wait and watch out for. Yes, on a structural basis, we are now on a very, very strong footing. Several long-term building blocks are now in place. We feel that the housing affordability is at an all-time best level seen in the last 15 years. The corporate NPL cycle is showing signs of peaking out, which should in a way sort of lend itself to the next leg of capex revival. So all those trends sound towards an optimistic future, but I'm just worried about what happens over the next 1 or 2 quarters when the full impact of the higher interest rate kind of feeds through into the economy.
So when you say there is still more need for valuation correction, we were at about 20-21 times. We've come down to about 16 times.
Right.
But we're still higher than the last 10 years
okay,
average.
so let me put in context some of the things. So if you look at the other bigger emerging markets like the China, Brazil, Taiwan, Korea, etc., all the major emerging markets are now trading below their historical averages. India is the only market, I would say, that is trading above its historical averages. The reason why the valuations have got corrected all across the emerging market is obviously the way the interest rate environment in the US has moved up. Over the last 5-7 years, we have been used to seeing US LIBOR rate at almost 0%. Now we're at about 2.5 to 3% range. The Euro LIBOR is still in the negative region, but our house view is that next year onwards, we will begin to see tightening in Europe as well. So when the global funding currencies are seeing the interest rates going up, it has to have some impact on the emerging market valuation, and which is what we are seeing at this point in time. Now, Indian markets have still held up better in valuation multiples because we have a very strong domestic support. The support coming in from the domestic retail investors. And so long as that sort of continues, we will still trade at a premium valuation.
Did that encourage you, as in to see the month-on-month numbers where domestic participation has continuously been rising?
Absolutely, absolutely. So the domestic flows have been very, very resilient, and that is clearly sort of one of the strongest point, in favor of the markets. But that's where some of the foreign investor concerns also come through, which are on the valuation side, as I just mentioned, because elsewhere the valuations have moderated much more, and in India they have not. So I think what we really need for the markets to continue to perform is that domestic investor support is sort of critical for the markets to perform, because I don't really see in any big way the foreign money coming in just as yet.
Okay, so when you say...
Okay, that's of course Mahesh Nandurkar in conversation with Devina at the CLSA Annual Investor Forum in Delhi. Let's get back to our markets. A lot of stocks reacting as the pre-open rates settle down. While it's a flat day for the large caps and the markets at large, the mid caps are a different kettle of fish altogether. Yes Bank, the principal loser, starting off about 3% lower. There is a block deal that has happened in Kotak Bank already. 1.27 crore shares have changed hands in Kotak Bank in a block deal on the NSE on the pre-open session. Remember, as we told you, that we learned from our sources that ING may be on its way to selling its stake in Kotak Bank this week. Maybe this could be a part of that. We'll get to know more about it later on, but this has already happened. The top loser, though, is Yes Bank in the pre-open session. Ruchit, just a quick thought here. Parthiv, just a quick thought here. Some developments have happened in Yes Bank. Quick 1-minute answer. Would you look at Yes Bank currently with all that's happening, or would you bide your time?
Not really, Neeraj. I think I have more preference for other private sector banks, and Yes Bank, I think, let the entire dust settle. I think all these exits and the change in the management guard and probably the last quarter, which did show some deterioration in the asset quality, I would like the dust to settle and then probably take a call.
Okay. So don't really look at Yes Bank is what Parthiv is saying. The pre-open rates have now firmly settled, and we have a start which is likely to be very, very flat for the large cap indices, the mid caps and the small caps, as we said, different kettle of fish. Suven Life, somebody mentioned on our live chat, came out with numbers which weren't the best, and that stock is looking like starting off 5% lower. We'll talk to Parthiv about that. What's actually done really well in the last couple of days is Dilip Buildcon, up another 6% today after a big move in trade yesterday, and Jet Airways up 5% after a move in trade trade yesterday as well. So we'll talk about these two. Actually, Ruchit, if you can quickly come in, 30-second view on either of these two stocks, if you have one, Dilip Buildcon or Jet Airways.
I think among these two, Dilip Buildcon yesterday it has formed a bullish candle pattern with along with a good volume. So we can see a pullback move getting extended in today's trading session as well. If I get a minor dip in today's trading session, maybe around 465, 462, then one can look to enter fresh longs. Stop below 3 would be 395, and short-term targets would be somewhere around 530, 540.
Okay, gentlemen, stay on. Lots more to talk about. Just minutes away from market open, let's tell you all that you need to know to stay ahead in trade today. Some of the last few companies coming out numbers, Shrey Infra, DCW and Capri Global, Tiny Toons will report the numbers today. But amongst companies that reported numbers post-market hours yesterday, United Breweries, Indian Hotels and Ujjivan Financial Services reported numbers that surpassed analyst estimates. On the other hand, the numbers of Grasim, Thermax and Future Retail were in line with estimates. Infibeam Avenues reported numbers which have made the stock go up about 2.5%. Vodafone Idea has plans to raise up to 25,000 crore rupees via various options. It seeks 7,250 crore rupees from the Aditya Birla Group. Yes Bank's non-executive chairman Ashok Chawla resigned late last evening, saying that he would want somebody who can devote more time to the job during this period of transition. And lastly, the ING Group aims to sell its entire 3.7% stake in Kotak Mahindra Bank this week, aims to complete this transaction via block deals. That stock is holding out in the session today. Okay, 3 minutes left for the markets to kickstart it. In fact, 3.5. What's done well today is Ujjivan on back of numbers which look reasonably okay. Have you looked at the charts of Ujjivan Financial Services, Aditya?
I just checked the charts of Ujjivan. So it's formed a base around 180 to about 170 odd levels. There were good volumes at those levels, and from there the stock has bounced back. So it's trading healthy at current levels. Probably one can take a long at current levels of 218 if the stock opens up. Probably as the pre-open markets are suggesting, the stock might open up. So probably there can be a trade post that gap up opening as well.
At 226.
Yes, one can go ahead and buy even at 226. A stock will be slightly deeper, close to about 215 to about 210. That will be the zone where I'll put the stop loss. Targets out here could be as high as 260 as also.
Interesting. Parthiv, enthused to buy into the small finance banks. They have had this correction, course correction. The numbers are looking okay thus far.
Yes, certainly. I think Ujjivan came out with a fantastic set of numbers in terms of the AUM growth. It was one of the highest sets in the last 2 years. The only slight concern, which is an obvious concern, is the incremental OPEX cost because of the scaling up of the banking operations. But for now, it seems the worst is over for the small finance banks, and the yields have cooled off, which is always a good thing. And despite the impact of the higher cost, I think their NIMs at 12% was one of the best. So no doubt, I think things are looking good. But as I mentioned, I think one has to be selective in terms of what to have in the banking portfolio. And currently, the valuations at which some of the private sector banks are there, my preference is more towards there, purely based on the stability. But even these mid-cap, I think small finance banks can create a lot of value over the next 3 to 5 years.
Okay, now very close to market open, we'll talk about a few companies post-open as well, the likes of Motherson Sumi, the likes of Ashok Leyland, amongst others. But about a minute and a half left for the markets to kickstart trade. Remember, our experts have already stated from a trading perspective that they're not looking at the Nifty in any kind of fashion for a trade. They're being very, very stock specific, so you got to keep that at the top of your mind. Before I get in the top call from our experts, just a quick view, 20-second view. Aditya, on Jet Airways, looks like starting off 5% higher at 270. What would a trade be? Quick 20 seconds.
Oh, I wouldn't take a trade post this gap up opening. There's a resistance around 275, 276. That happens to be the 100 simple moving average. So if it crosses that, then probably I'll take a fresh trade. Post this 5% gap up opening, I would avoid taking a fresh long in Jet Airways.
Okay, so no fresh longs is what Aditya Agarwala is saying in Jet Airways, because it's run up a bit. It might start off 5% higher in today's session as well. Let's nail it down to that one top trading idea from both our experts. 40 seconds to go for the markets to kickstart. Ruchit, to you first, your top trading call for the day today.
So the Grasim since last few trading sessions has shown a pullback move, and post testing its retracement resistance today, it is indicating a gap down opening. So one can go short in Grasim. I would recommend taking a sell trade in Grasim with stop above 885 and expect target around 830 to 827.
Okay, so Grasim is the top short call or top call for today from Ruchit. Aditya, what about your top call?
I'll go long in Apollo Hospitals. The stock is breaking out from this consolidation phase. I'll go long at current levels of 1168. Targets out here could be as high as 1240 to about 1270. I'll keep a stop at just below 1120. There could be a good decent up move in the stock.
Okay, so Apollo Hospitals, long from Aditya Agarwala. Here's how the markets are starting off today. Flattish, I would reckon, very, very flat. The mid caps and the small caps too could start off very, very flat. I dare say watch out for Kotak Bank and the volumes there. Mid caps and the small caps too, very, very flat. Even Stevens, maybe for the Nifty 50, the heat map should come up on your screen. Yeah, I mean, okay, no, the green has got more weightage, but let's see if that lasts. Grasim and Yes Bank both start off really weak. 6% lower for Grasim, 4% lower or 5% lower for Yes Bank. On the flip side, Kotak Bank, after the slam dunk yesterday, up about 1.5%. iShare about 1.5%. Tata Motors about 1%. But those are few and far in between. A lot more green than red, but this is quickly changing. And the losers are really succumbing to some selling pressure. IT2 under a bit of stress today after yesterday's carnage. So TCS, Infosys at least, the two of them starting off with mild bits of red, about 1% apiece for both of those stocks. But the real action is not on the index, frankly. It's a lot of stocks outside the index too. So let's highlight 2 or 3 pockets that I want to bring to the notice of our viewers. Very strong quarter for United Breweries. Stocks sort of about a couple of percentage points higher. Margin expansion, profit growth. Let's see if there's more in store. Now building up strength. What about some of the others? The stocks in focus. Grasim already spoken about bad results and the Idea overhang, down about 6.5%. Vodafone Idea itself down about 5%. I don't think the market is really focusing too much on Bharti Infratel right now. The stock that's fallen quite a bit already, but lots of permutations and combinations about whether there needs to be a stake sale in Bharti Infratel from Vodafone's side in order to raise money for pumping money into Vodafone Idea. So maybe too far-fetched right now. Focusing on Grasim and Vodafone, both of those are down in the session today. What about a couple of other companies on which the results came out and the results impact? Indian Hotels not quite reacting positively to what appeared to be a very strong quarter and very positive commentary as well. Thermax, I thought that the margin disappointment, in contrast to what the management has been saying, would have brought the stock down, but maybe it was in the price or in expectations. The stock not really starting off on a weak footing, about 3% higher. Opening quick thoughts from all our experts. And Ruchit, before I ask about some other stocks, a quick thought here on the Nifty. I'm guessing you're not trading that.
Yes, certainly, Neeraj. For 10,600 levels, the resistance is around 10,650, then 10,750, and the support is quite far from current levels. So I think there is no point trading index at current levels. You won't get a favorable risk-reward ratio. Rather, I would again stick to be stock specific. In case if one is already long on Nifty, have bought at lower levels, then keep somewhere revised stop loss below 10,500 and hold, but around 10,650, 10,700 when it comes, also look to book profits over there, because the upside from here on may be about 100 to 150 points, not more than that.
Okay, some stocks that I want to mark. Dhanuka Agritech is up about 7%. HDL is up about 5%. Jet Airways about 4.5%, 270 odd. So not a bad start. And some cement names have some gains. Heidelberg, Kesoram amongst others, or cement and cement related names are doing well. What's not doing well? PC Jewelers and Suven Life. Suven Life is down about 8% in the session today. So not a great start for this one. And Vodafone Idea, of course, starts off 5% lower. Just wondering, Suven Life Sciences, Parthiv, do you track this? You track a lot of pharma names. I don't know if you looked at Suven at all.
Certainly, I think Suven is primarily into the new chemical entities where it has a decent pipeline. But the biggest issue this quarter, and probably Neeraj, I'm envisaging even the next quarter could be challenging. All of a sudden, there's been a structural shift in terms of many of the intermediaries that the Chinese companies were supplying to many of the Indian pharma names. And the prices have spiked out there. And I think these companies have not been in a position to increase their API prices in the proportion. And also some of the formulation business has got hit. And Suven majority revenue currently comes from the CRAMS, NCE CRAMS business, where I think there was certainly a lot of cost pressures, and probably the management did indicate that this might last for the next 2 to 3 quarters, as a result of which the stock has massively derated. I think the only hope some of the long-term investors in Suven have is some of their molecules which are in the phase 2 stage, and I think the Alzheimer's molecule, where there's a huge potential of monetizing it via licensing, but that's going to happen over the next 2 to 3 years. So I think it's a very, very longest sort of a story. more like a research play which pans out on a longer horizon. So only very patient investors who believe that the story will pan out, so when is a stock for them. But otherwise, I think the pharma space, we are more bullish on some of the MNC plays which are very bullish on the domestic story. Names like Abbott, Sanofi, they're showing fantastic results, and going ahead I believe that they will have the pricing power and the domestic market growth story is there for such companies.
Okay, the other stock in focus, and Aditya was referring to that stock as an idea, is Apollo Hospitals. Remember, the numbers came out, but more importantly, they've announced the pharma business restructuring. The standalone pharmacy business requires greater focus and attention, and therefore the front-end pharmacy business would be segregated out. We'll talk to the management as well. But since you gave that call, I'll first come to you and then get the fundamental call. Good one out there. Aditya, the question is, can somebody buy it even now?
Yes, I will go ahead and buy even at current levels. I see a good upside in the stock. It's breaking out from a falling channel on the weekly charts, which is a very healthy sign. One can still go ahead and buy the stock. Targets out here still remain 1250. If it crosses 1250, I'm looking at a higher upside target of 1350 as well in the stock.
Okay. Can we bring up the this year's chart for Apollo Hospitals? Because somehow these hospital companies, diagnostic companies, etc., haven't quite had a great run. This year has been absolutely flat. Parthiv, this announcement certainly comes when the stock hasn't had a big run except for the last couple of months. Would you be enthused to buy into Apollo because of this segregation of the businesses?
Yes, I do believe in this story, Neeraj. The stock has time corrected for a number of years, and I think it's been frustrating kind of holding such companies for a very long period of time. But my sense is that one can't avoid the healthcare story in the country, and I think one of the best plays, and even if Apollo were to get some sort of scarcity premium, it would deserve, because most of its peers are lagging in terms of the return ratios that Apollo is showing. And I think with the demerger move certainly creates more value and I think more focused approach going ahead. And I do believe if anyone wants to have a stake in the India's hospital story, I think currently amongst the listed market space, Apollo is the best in the pure play. So certainly I think I would like to own such stories, consumption-based stories rather, I would say, for the next 3 to 5 year horizon, and Apollo should not disappoint, I believe.
Okay, then I want to talk about Motherson Sumi with Parthiv, but before that, two nifty names which have corrected strongly. I can't ask you about Yes Bank, I can ask you about Grasim, 6.5% lower. What are the levels that the chart suggests?
I'm looking at immediate support of 780 to about 773. That is the support zone. It's still far off from the level that the stock is currently trading into. Though stock has bounced back from the lows of 796, but it needs to be seen whether it holds on to the pullback. Probably 840 is an immediate resistance. If the stock fails to take out 840 and cross that, probably I'll go ahead and short closer to about 840, and targets out here could be 780 to about 770.
Shorts in IT could be smarting today because HCL Tech, Wipro, Infosys, all of them have bounced back. Ruchit, just a quick perspective. If you were short on TCS, would you square your short positions?
I would continue to hold it from next 1 or 2 weeks perspective, because IT relatively we believe that the underperformance would continue in short term, and specifically TCS, if we see, then the targets are coming about 3 to 4% lower from where the stock is trading right now. So continue to hold on shorts if any, keep a stop loss about 1930, and expected target would be somewhere around 1800 to 1820.
Ruchit, quick perspective on Yes Bank, down about 4%.
I think this would continue to underperform. Even after this pullback move that we have seen in this month, there is no higher top, higher bottom structure yet on the charts. So unless we see first higher top, higher bottom structure, there's no point buying the stock on declines. So avoid any kind of bottom fishing in Yes Bank here.
What's doing well is Adani Transmission as well, 7.5% higher. Dhanuka Agritech, I already spoke about because of the buyback news, is up about 5%. Jet Airways is up about 4%. I'm also interested in seeing what Motherson Sumi is doing after the slam dunk yesterday. Should come up on your screen. Big move down the downside, and in today's session too, after opening slightly higher, has come off. The stock has been a bit of a disappointment, Parthiv. They're sticking to the guidance. The management is citing positive commentary, but now it is in line with some of the other large cap names wherein almost every quarter there is buoyancy in commentary, but somehow it fails to meet market expectations. If you had a slightly long-term perspective, would Motherson Sumi be an auto ancillary company that you would buy, or would you look at buying into some of the other auto anchors?
My sense is that I think a market like China, which is a key market for Daimler, which is a very important customer for Motherson Sumi, if Daimler is complaining about the volume growth, if people like BMW, Audi, JLR are complaining about volume growth in key markets, not only China, US and Europe, and there's some sort of tepidness in the luxury car market, and I think that's where from most of the bulk of the revenue of Motherson Sumi and the order book that they have comes from. Not all the order book is quite decent. The acquisitions that they did recently are panning out well. But my concern is the return ratios. This is a company which might show decent top line growth and probably they would even meet their guidance of the top line that they're targeting. But I think the concern would be in the return ratios. The ROC that he had talked about, which is extremely high, and most importantly, the expansion in the ROAs and the margins. I think margins is the place where many of the luxury car makers who have lowered their EBIT guidance, I think they're certainly going to put more pressure on companies like Motherson Sumi to decrease the prices of their components. Not all the management is quite upbeat, but my sense is better to wait out over the next 2 to 3 quarters. Motherson Sumi historically on every decline, such huge declines post the results, has proven out to be a good investment case. But this time I believe it's a best idea to wait for 2-3 quarters. Probably there could be further derating of the stock and further 10 to 15% corrections from current levels would probably discount in all the negatives. And that's where I think long-term investors should take a call.
Okay, maybe valid points here, but interesting what's happening to Motherson Sumi the last few days and the way it's coming off. In fact, the last 1 year hasn't been particularly great for this stock. PC Jewelers has fallen off today, and now Vodafone Idea is down about 6%, 39 and counting. Repco Home Finance, the numbers look slightly wobbly. The stock is down about 5%, so do watch out for that as well. What else? As we've said, Suven Life Sciences is amongst the stocks that is also correcting in the session today. Nifty IT has not had a bad day. It's starting off reasonably okay, and as we said, some of the IT names are doing rather well for themselves. Aditya, would you consider this to be a good time to go short on any large cap IT name?
Probably this is just one of those up moves, probably short covering rallies that we are seeing. Once this is done, probably I'll see fresh shorting. So TCS continues to look weak to me, probably close to about 1900 or 1910 zone. I'll look to go short again in TCS despite this 0.5% up move. There is weakness in TCS, no doubt. Probably stocks can correct to levels of 1780 to about 1750.
Okay. Hero MotoCorp is up, Eicher Motors is up, Titan is looking slightly strong today, 907 and counting, so good going here. Parthiv, a lot of people would be wondering if they want to put in fresh money to work, where is it that they can do? One stock idea and the rationale thereof.
Yes, Dheeraj, I think I have a very contra view on the power sector, and yes, this is a sector which is totally been neglected, avoided and not owned by many of the smart investors. But I feel that in a country like India, without growth in this sector, I think we can't see the industrial growth, and we are seeing nice uptick in terms of the power tariffs. And one stock which I feel is a very safe stock to own in this sector would be JSW Energy. The stock has done nothing. Literally, I think ever since the listing, I would say the stock has really done nothing. The capacities have grown, and this is a very, very efficient power producer. And I think the bet is also on a capital quality allocator management like that of Sachin Jindal. They have differentiated plans in terms of having the EV segment stations for the electric charging. Yes, that would play out in a very, very longer horizon. My current bet is on the core business, where operationally things are turning around, and I'm expecting with the currency also stabilizing and the coal scenario improving at Coal India, where there's a directive from the government to produce more coal for especially power sector. I think the company can get its pricing power, can deliver very good return ratios, and I think the stock can be a good bet over the next 2 to 3 years.
Okay, gentlemen, on that note, all three of you, thank you so much for your patience today. Thanks so much for being with us and giving us your thoughts. Really appreciate your time, all three of you. And tell you what, let's take a break on the note that the markets are lying absolutely flat, but a very important conversation coming up on the other side of the break. Chris Wood from CLSA joins us from the annual investor forum in Delhi. You can't afford to miss this.
Good news, guys. Got a promotion and a damn good raise.
Congrats, beta.
Congrats, मेरी तरफ से भी.
From mama too.
वाह, रेज. अब तो इंश्योरेंस पॉलिसी ले ले.
इंश्योरेंस? कौन सी कंपनी से लूं?
सोचना क्या? चूज वही जिस पर हो पूरा भरोसा.
वीरू, go for convenience. My company is online, quick and simple.
बेटा, बट पॉलिसी समझाएगा कौन?
वेबसाइट पे सब है पापा. I can even call and ask.
क्लेम सेटलमेंट का रेशो क्या है? मेरी कंपनी का 98% से ज्यादा है.
That's good, but आज की generation wants everything online. Easy premium payment options, loan facilities और wide range of products.
अरे पापा दीदी, I will decide. Just send your links now. तुम दोनों भी ना. Same choice. LIC.
LIC trending with times 62 सालों से हर जनरेशन की पसंद.
Thanks for tuning in to Alpha Moguls, a show where we speak to some of the finest investing minds about how they are approaching investing in the current scenario from the medium to the long-term perspective. Our guest today is Samit Vartak of Sage One.
I have much more confidence in probably assuming that in the next 3 to 4 years, their earnings will double. And given the valuations, generally there is very little chance that the valuations will get derated over that period of time. Just forget about the price you bought at. Just look at forward. Which are the stocks which will deliver going forward? The private credit cycle is where the profits come through.
Back with IndianOpen right here on Bloomberg Quint. Flattish for the markets, but let's get in some important conversations. Maruti's management in its recent earnings call said that it will be a challenge for them to maintain growth above the 10% mark. Samit Vartak of Sage One Investment Advisors agrees to this. On a special series Alpha Moguls, Vartak talks about why it takes only 1 quarter of disappointment for expensive stocks to see a sharp correction. Listen into a small slice of that conversation of Alpha Moguls.
If you look at 6, 7, 8 years back, or especially in 2010 through 2013 period, a lot of these companies were available at really cheap valuations compared to their growth potential. Like Page Industries, I didn't invest in 2008 because I started late as a professional investor. When I invested, it still was available at 35 times P multiple.
And you thought that was cheap then?
Yeah, because it used to grow at 30-35%. Annualized earning growth with a return on equity of more than 60%. So when you look at from any angle of valuations, it seemed cheap. Same thing with Bajaj Finance. In 2009-10, when I entered, the price to book was 1, and the return on equity used to be 20%, which was on the higher side of
NBFC.
Even today, the return on equity has stayed there at 20%. It's just trading at 7-8 times price to book. I think the important factor in these kind of investment is understanding whether the growth assumption is sustainable or not. I'll give you an example. So La Opala, right? So in 2011-12, I visited them. No one knew about La Opala, and then realized there was an anti-dumping duty on the opal ware from China and Taiwan, and which was for 5 years. Right? And China and Taiwan's import was almost 50% of the market, right? And this was a company which was probably the best known brand, in tableware, and available at like 9-10 times. And I thought it's a great buy because it's a consumer-oriented company having 50% of the market opening up for it, and it was putting up a new plant. Got in, within 6 months, the stock tripled. And then you find that, okay, it's expensive, and get out. The stock goes up 5x more from that point in time. But what I'm trying to say is that you have to be aware that there was a 5-year window because of which the growth rate picked up. It picked up from 10-15% to 25-30% because it was that 50% market which opened up. After those first 3 years of market share gain, the growth just stopped. So you can't keep on giving higher valuation to these kind of businesses where the growth rate suddenly drops to 10, 12, 13%. Because 10, 12, 13, 15% growth rate is very normal. You can give higher multiples to companies where they tend to grow at 25%, 30% plus over a prolonged period of time, and where you need to understand why the growth is coming. Like Page Industries, when you look at if you separate out their same store sales growth versus the increase in square foot, you will see the trend that the increase in square foot in the initial stages were much higher, but as you cover in the entire nation, as a percentage you can't increase the square. So whereas your same store sales growth might sustain at the level, but the same store sales growth will be in single digits, sustainable. If you can't add 10% plus square footage, you can't grow at 20% plus. And that's today, it's extremely difficult. It's improbable that they can do that over the next 10 years. And then when you see a valuation of 85 times or 90 times, it seems very, very expensive.
Interesting. Okay. Which brings me to my two questions. One is these consumer names, the staples, the large ones. Do you reckon that some of these, because of the fact that they need very less capital or almost no capital to grow, they would keep on attracting these higher multiples? I mean, some are trading northwards of 50, some are trading 55. I don't know if you're invested in any or some of those, but without that being a factor, do you think those valuation multiples can sustain?
See, my experience has been these valuations sustain until the point when they disappoint you, even for a quarter. So, for example, Bajaj Finance will sustain this at least 6-7 times price to book until their growth stops and falls below 20%. But when it falls below that expected growth rate, the correction is extremely sharp. So today, see, again, as I said, I did that analysis of the top high-quality companies. If you build a portfolio, the portfolio can't just have 2 or 3 companies which are high growth, which are available today, right? So you will tend to build a portfolio of, say, 14, 15 stocks. And when you go to those many number of stocks, the earnings growth drops to 11, 12% for these high-quality companies. And when you're already trading at a PE multiple of, which difficult to re-rate, that means your returns are going to be mostly driven by the earnings growth. That means you're already limiting your returns to that earnings growth rate, which is below 15%. And if you hit a pocket where the growth rate slows down further, there is a risk that the multiples might get derated. In the next 10 years, you won't probably be affected by the derating, but you would have seen what happened with Maruti. It can happen in a quarter that they correct 30-35% once the growth rate stops. And it can happen with any stock. It can happen with the Bajaj Finance. It can happen with Page Industry. I've gone through a phase where Page Industry didn't move anywhere for a long period of time. And that was a period when people were assessing whether the growth rate has just slowed down permanently. And but it picked up, and then you again got re-rated.
Okay. So I'm not asking for a call on the stock, but do you believe that the growth rates on Maruti could have hit a bit of an air pocket? I mean, the management has said that sustaining 10% this year is going to be a challenge.
Right.
Do you believe that could be a challenge that they could face, not just for FY19, but maybe the years ahead as well?
Yeah, so not specific to Maruti, but I think, as I gave you an example of La Opala, right? The growth rate comes from, one is the industry growth rate, another one is your market share gain. No company can really outperform the industry
meaningfully for a long
for a long period of time, unless they keep on gaining the market share. So in this example of Maruti, they probably are the dominant market share. I don't know how much further do they have.
And you can catch the entire conversation today at 10:30 a.m. only on Bloomberg Quint Live. But let's go across to Devina, who's in conversation with none other than Christopher Wood, Global Equity Strategist at CLSA, live from their 21st India Investor Conference. Devina, over to you.
Thanks, Neeraj. So we're here at the CLSA Investor Conference from Gurgaon, and joining me right now is Christopher Wood, Global Equity Strategist at CLSA. Chris, thanks very much for taking out the time and speaking with us. Let's start off first with the CLSA house view on the equity markets, particularly emerging equity markets, and then your outlook on India?
Right. Well, my view in all markets is that the obvious risk is US monetary tightening. The way I look at it, we've had a rolling correction, began with the cryptocurrencies, the most high beta asset class, rolled into emerging markets, Europe, Japan. At the end of last quarter, the US was the last man standing. US equities clearly corrected in October. The way here, at this point now, I think there's a good chance of a rally if we get this US-China trade deal, which is my base case at the G20 summit or around about that time. So if such a deal happens, that should be a counter-trend rally, probably led by Asian equities. But at that point, we will then have to stop and realize we still have ongoing US monetary tightening. So I don't think we're out of the risk aversion phase yet. What I'm hoping is that Asia and emerging markets underperformance relative to the rest of the world has bottomed out.
Yeah. So do you see a significant turnaround post this correction? Because China is still in a bear market. We've been seeing a lot of pressure building up in Hong Kong, and Indian markets have corrected almost 15%, though the recovery also has been good enough.
Right. Well, in the case of China, personally, I think China's equities are extremely cheap. I think a lot of the weakness in China equities is self-induced by government deleveraging. The Trump administration thinks the weakness in the Chinese stock market is driven by the trade dispute, but it's not. It's driven by the squeeze on shadow banking. I think there's been a lot of forced selling in China equities this year for various technical factors, and I believe basically Chinese equities are very attractive at this point. The risk in China the next few quarters is weakening in the property market, but the Chinese have a lot of policies they could implement if they wanted to stimulate. So personally, China's a market I would be buying today if I'm an emerging Asian portfolio manager. India, I think, is going to provide a buying opportunity, but I wouldn't be rushing to buy India like right now today. I think the buying opportunity is going to come more likely after the state elections first quarter. If the BJP does not do well in these current state elections you're having, then, which is a distinct possibility because people often vote anti-incumbent, then you will get a lot of noise that Mr. Modi won't be re-elected, and that the domestic investors here will get more nervous. I think that will create a good buying opportunity for foreigners, because in my view the Modi government will be re-elected with a diminished majority, but I believe there's a lot of room for people to worry that it won't.
So is that the only reason that's keeping foreign investors away, waiting to know the result of the elections?
No, I'm not sure. I don't think the foreigners are obsessed on the politics as the locals. But I think what's unnerved the foreigners is what's just happened happened a month or two ago in the credit space, where you've had a AAA rated bond default, which clearly has caused a big concern. And clearly, in the whole housing, non-bank financial space, you're going to have a significant slowdown. But based on my very superficial observation from initial meetings this week, I'm hoping, with the emphasis on the word hope, that the worst has been seen in this area. But going forward, there's going to be a material slowdown.
Right. But would you paint all the NBFCs with the same brush? I mean, there are...
No, but the bottom line is if you have a AAA rated bond default, then it's going to make the market nervous. So what it's going to mean in reality is that bond investors are going to invest first and foremost on the names of the parentage, because they're no longer going to believe the credit ratings.
True.
So that's a big problem. Because not everybody is a subsidiary of a long-established parent.
You have a significant chunk in your model portfolio for NBFCs and the financial space as a whole. Are you tweaking around?
If I was running, so this portfolio, this portfolio is a good example, because this portfolio was outperforming the Asian benchmark quite significantly until the events happened, which I believe was late August. And so this portfolio got smashed in the month of September, because I've always had, actually, since I began this portfolio, which is a long time ago, 2002, probably the biggest weighting for the whole period has been Indian financials. So I know I'm not panicking out, but but the point is, it's a big hit.
It'll be a slow and gradual recovery.
Yes, because without any doubt whatsoever, the rate of growth is going to slow in this area. Long term, I think this represents a huge opportunity, particularly in the property space, because in my view, the residential property sector in India was already facing what I call a double whammy. The double whammy was first demonetization. The second was the introduction of the Real Estate Regulation Act, RERA, which I think is a very good piece of legislation, but clearly it's going to cause consolidation. So we're already looking at a brutal consolidation. We're now getting a triple whammy because clearly liquidity, because these housing finance companies are finance developers.
Yeah.
So there's a triple whammy. So what people need to be doing is working out who are the well-capitalized property developers who are going to benefit from what's going to be absolutely brutal consolidation.
But that means that they now need to focus more on getting rid of their inventory and start selling a little bit more instead of just, holding on for liquidity in terms of bank credit or any other
No,
form.
sure, but this consolidation was already happening.
Yeah.
It's just going to become more dramatic. But in my view, you want to own the quality property companies who are going to benefit from the consolidation. Meanwhile, amidst the bearish sentiment, we need to remember that the affordable housing build-out is still going on. The affordable housing program is underway, and that's very positive. And you want to own stocks benefiting this area. The other good news for India short term is oil coming down. Actually, though, on a one-year view, my biggest concern on India is oil, because I still think there's a lot of potential for oil to go up. So I think the oil correction you're seeing of late is simply driven by the news flow in Iran.
Yeah, and OPEC saying that the demand for their own crude is coming off on the backdrop of the economic slowdown.
Yes, I'm not quite sure where OPEC's getting that from. But to me, the key variable is we've gone in a space of 2 months from the world assuming that the Americans are going to put sanctions on anybody bought any Iran oil whatsoever, to the Americans doing almost 100% U-turn and making these significant exemptions. So I personally think that's the key reason for the round trip in oil.
So in your view, the long term, you do see crude oil going higher?
I think there's a material risk that oil goes significantly higher, so the Indian government should be aware of that risk, and it would certainly be very dangerous to assume that oil has peaked here, because the fact is there's very little evidence so far statistically of demand for oil slowing. I know these are just forecasts.
Yeah.
And the reason demand for oil keeps exceeding the IEA forecasts is because of demand in emerging markets. Actually, India is actually about to get to a level of GDP per capita China was back in 2001 when oil demand exploded on the upside in China.
So the excitement around crude oil coming off and the positive implications for CAD may be short-lived, is that what you're saying?
Yeah, I'm saying the key thing is a big relief that this Iranian sanctions were not enforced. Otherwise, I think oil could be way higher.
Yeah. What's your target for crude oil?
No, I'm not an oil analyst. The reason I'm highlighting this is because demand remains strong, and the supply from conventional oil industry is not increasing. There's been hardly any investment by the conventional oil industry for the last few years because of this whole alternative energy movement. So the key variable is how much US shale production can increase.
All right. Is the markets now looking at liquidity being a crucial aspect in the US as well? Because US so far has not been in a phase where they've not had access to cheap and easy money. Now, as we take a turn around the corner where there's a pullback of QE, you're going to see the effects of...
No, absolutely. So basically you've got a double whammy of monetary tightening going on in the US. You've got obviously Fed rate hikes, but you've also got accelerating Fed balance sheet contraction. So that's just plain negative for risk assets. And you're going to have, as we go into 2019, the huge stimulus effect of tax reform start to come out of the numbers. But I think the tax reform has been hugely positive for the US stock market this year, and explains why it took until October for monetary tightening to hit the US, because first of all, there's higher cuts in taxes was a big boost to corporate earnings. But second is the repatriation of American corporate money offshore, which was basically incentivized by the tax reform, which has led to a renewed explosion in share buybacks. So the first 2 quarters of this year saw record high share buybacks. And that's the single biggest reason why the US stock market has outperformed.
What is the bearing of that for a market like India?
Well, so that's actually the money going back into America has been a negative for emerging markets because it's created a bit of an offshore dollar funding squeeze. So the key driver of relative returns this year in world markets is not economic growth, it's US tax reform. US tax reform has been bullish for US stocks and bearish for the rest of the world because the money's gone back into America.
You know, when we're talking about liquidity, it is a term which makes headlines, you know, on an almost a daily basis for our markets as well. The RBI has been doing its fair bit to make sure this systemic liquidity stays. You know, are you happy with the proactiveness of the RBI?
Well, I'm not here, so apparently some measures have been taken. I'm not sure the government. I'm not sure the government is completely happy with the RBI. But I would say, in terms of this current noise, media noise about the dispute between the RBI and the government, personally I'm more sympathetic to the government than some commentators because the reality is the central bank has been running a pretty tight monetary policy in India in recent years. Because my understanding is the central bank has an inflation targeting policy and they're targeting headline inflation. So if that's the policy, they're running very high real interest rates relative to headline inflation. So that, I think, is why they are vulnerable to criticism, because it looks like headline inflation has come down significantly in India, partly because of cheaper food prices, which I am told, I'm not an expert, reflects in productivity improvements in Indian agriculture.
Sure, but which is why they held interest rates the last time around, and they're probably most likely to do so this time around as well.
Yeah, but you could argue that rates could be materially lower in India. Now, if they're running monetary policy around concerns on the currency, then that would justify potentially having higher rates. But all I'm saying is there's a legitimate argument that monetary policy is being too tight. Most particularly given that credit growth is weak and you have this legacy problem in the banking sector. So personally, I think monetary policy has been too tight. I think this argument of, you know, the central bank being overcapitalized has some legitimacy. And I think anytime you can buy the Indian 10-year government bond at 8% yield, which you couldn't until a few weeks ago, is good value. So I think at 8% foreigners will come back and buy Indian bonds. So to me, the big risk in India right now, from a bond currency point of view, actually is external, outside the control of the Indian government. That's what we were talking about earlier. The oil price, one is the oil price, and two, how much more the Fed tightens.
Yeah, sure. So the recent fine print on the FII interest in the bond market has been slightly more positive. You've been seeing some buying coming back into the bond market. Do you see that likely continue?
I think if the US Treasury's yields peaked here, definitely. But personally, I would be a buyer of Indian 10-year at 8%.
Okay.
That to me is good value. And I think precisely because the RBI has been running a tight monetary policy, it makes Indian government bonds attractive.
At this juncture, would the strategy be to probably sit on cash a bit or deploy more in the equity markets?
No, I would be looking to buy them. But first of all, I would be buying bonds around 8%. So
over equities?
Yeah, no, I think if I didn't own any Indian equities yet, I personally would be waiting for the state election results and this commercial paper to be rolled.
Okay.
Because first of all, I want to see the commercial paper rolled. Everybody tells me it's going to be rolled okay, but you know, I'd rather just see it happen. And then the second point, I might as well wait for these elections because because there's obviously got to be a chance that the BJP doesn't do so well, because there's always a bit of an anti-incumbency sentiment in these elections, and that could trigger some nervousness, and then I personally would view that as an opportunity to buy.
How does all this volatility, according to you, play out for the currency and the impression that that creates externally? Because obviously, with the currency weakening the way it is, the returns for foreign investors.
Yeah, but see, the currency having weakened so much, to me is now a positive. If I'm looking to invest, that to me is a reason for foreigners to invest. Because I don't think I don't think the monetary policy is quite tight. To me, that's an opportunity, not a negative, as of today, because it's already weakened.
So a fair value of 70 to 73, natural cost of the rupee.
Yeah, but if oil goes to triple digits, if oil goes above 100, which in my view is not impossible, clearly Indian rupee can come lower. So if I own Indian domestic equities, which I want to own, like the financials, in a portfolio, personally I want to hedge it with oil plays, with stocks that benefit from higher oil, because I still think there's a material risk oil can go significantly higher.
All right. What else, aside from financials, that holds a significant chunk in your portfolio? What else is there?
Well, I would definitely own, I would want to own the healthy real estate plays. And going forward next year, I think in the next few months it's going to make sense to try and add to stock, put more in an Indian portfolio geared to hope for the long-awaited capex pickup. Because I'm hoping that then by 2019 we begin to get evidence of capex picking up here. Obviously people have been hoping this for several years, but to me there's now a better chance this finally starts to happen. Most particularly if we see more cases successfully resolved in this bankruptcy court.
Right. You think this was a big positive that happened?
What?
The creation of the bankruptcy court?
Well, no, I think it's a huge positive, the bankruptcy legislation, but it's got to obviously be seen to work.
Yeah.
And it's become more complicated than it would otherwise be because this government, to its credit, is trying to ensure that former creditors don't buy their assets back on the cheap through the back door, which is what normally happens in these situations in other countries. So because they're trying to make that happen or ensure that, it means the process will take longer. But if they succeed in that aim, it will be extremely constructive. So yeah, I think the bankruptcy legislation is one of the major achievements of the current government.
Let's talk about valuations. Earlier on I was talking to Mahesh and he pointed out that our current valuations are still higher than what our Asian peers are trading at, considering a historical valuation. So he would rather be more comfortable if these valuations came off a little bit more.
I know, that's without doubt. The Indian market is not cheap. But most particularly as there's a risk that some of this earnings forecasts have not discounted the clear slowdown that's going to happen as a consequence of this credit crunch in the non-bank space.
So it's been just a similar amount of time that we've started facing issues with the credit crunch as we've seen this September quarter. So much of it probably will start reflecting in the consecutive quarters to come. So do you see more earnings downgrades?
No, I think there's a clear risk. But the stock market's already told you that.
Yeah.
So I've got no idea whether the analysts have downgraded it, but it's quite clear that growth's going to slow. I mean, in this particular area. So, but the Indian market, look, never is. The Indian market is certainly not cheap. If you're a value investor, there's much cheaper markets. You know, the Chinese stock market is dramatically cheaper than the Indian market right now. Most particularly if you exclude internet names. It's on single-digit PE.
Right. But the idea is not. Is the idea solely to choose a market that's cheap or that has a significant return on investment and the growth prospects seem higher? So even at a valuation which is slightly higher, because your growth prospects are there.
Sure, so that's why I don't think India will get that cheap. So I view India and China as complementary in a portfolio because, yes, I don't believe, but if you're an investor purely driven primarily by valuation criteria, you're never going to be overweight India. India has always been a market for growth investors, and India doesn't have dividends. See, these Chinese stocks have much higher dividends. So for investors who are focused on dividends and income, India is never attractive.
Chris, before I wind up, I'm just trying my luck here. Anything in specific, a pocket that you really like investing in within India? Maybe a fresh investment or probably adding...
No, if I was going to say to someone to make one investment for the next 5 years in India, the obvious thing to do is to take a view on which companies are going to be the beneficiaries of what's going to be an absolutely dramatic consolidation in the Indian residential property sector for the triple, because what was already looking like a dramatic consolidation based on what I described as a double whammy is now going to be a triple whammy.
Yeah. So up until now, real estate was written off. It was written off. I mean, there was not much happening in that space, but you're saying relook at it and have...
Oh no, I think you should already be positioned in the quality development. I'm just saying this has become an even better opportunity, but it's a 5-year view. It's not going to show up in 3 months.
Got that.
Yeah.
Chris, thanks a lot for joining and appreciate you taking out the time and
you.
sharing this space with us.